Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. Today's topic is going to be covered calls, and specifically, we're going to be talking about trading something known as the stock is king rule when selling covered calls for income. And it's actually going to go directly to a question that came into the chats right before the webcast started. And Ray, I saw that you asked the question. Can we talk about when a trader might consider rolling a covered call? That's going to work directly into this discussion. Really looking forward to everything we're going to be covering. But yes, the stock is king rule. What does it mean? What does it imply for entering and exiting covered call trades? We're going to be going through all of that. But before we can address any of it, let me first of all say hello to everybody already chatting in out there in YouTube. Great to see so many familiar names as always. Hello there, Josh and David, Eva, Selva. I never eat here. Jay Richardson, everybody else, Life in the Fast Lane. Great to see everybody. Thanks for joining us week after week. And if you're here for the very first time, I want to welcome you as well. Also, if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you are invited to join us in the live discussion. If you'd like to be here, this is a Monday webcast series, and we kick things off promptly at 2 Eastern. So we'd love to have you in the live audience. And for the as a little special benefit for our live audience members, we have my very good friend Brent Moore is going to be hanging out in the chats with us. Brent's going to be addressing any questions that I can't get to. And Brent and I have now been working together for more than 20 years. Great to have Brent here as a backup to help me out. Thanks for having my back there, Brent. And everybody, if you have an account with X, make sure that you're following your favorite presenters there. You can follow Brent on X at Brent Moore CS. You can find me on that platform at Cameron May CS. It really is the best place to connect with me in between these live streams. But let's get into this. Pardon me for a moment. The first thing that we need to do, of course, as we get into this discussion of an approach to trading or investing, we need to realize that investing and trading involves risk. Risk is real, and so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's lay out an agenda for what we're going to be discussing today. First thing that we're going to do is look at our current example trades. We have several. Now, it's a bullish market. And since we talk about covered calls and short puts, both of those are bullish strategies. It's been a fairly cooperative market, but I think there's one that we're going to be taking some lessons home from today that hasn't been entirely cooperative. But we're going to take a look at those existing positions, make any changes to them that we feel might be appropriate at the moment, including, Ray, rolling one of them. We're going to be doing that today. But number two, we're going to take a quick peek at the markets, and then that'll set the stage for this discussion of trading this thing known as the stock is king rule. Something that some traders bear in mind when they're trading covered calls for income. So let's go right to our current positions. We have 4 right now, but we're going to start one off. We're going to start off this discussion with a 5th. This is a position that we had when we last convened for this webcast, but something has happened since then. So we have GE Aerospace, General Electric, basically. So what's gone on with GE? Well, back here on May 12th, we bought 100 shares for $218. On that same day, we entered into a contract where we gave someone else the right to buy our shares from us for $230. Now, the stock rallied up above that 230 level and stayed above there. And as we hit expiration, yep, the contract was assigned on paper. This was a paper money trade. So our purchase that we made for $218.55, we wound up selling those shares for $230. That's an $11.45 per share profit. Plus, we kept the $299 premium, giving us a total $1,444 profit across our 100 shares. So that trade is concluded. Now, one thing about our paper money trade here could have been very different with a real account is that assignment can happen early, meaning we may have realized this $1,444 profit. Again, we're setting commissions aside in that calculation there, but it could have happened earlier. Early assignment is a realistic possibility with real accounts. Just doesn't happen in paper money. So wanted to make that note, but General Electric is now profitably concluded. Oh, one other thing I want to point out here. When we get assigned, especially when we are assigned, we have to sell the shares for less than they're worth. It can be tempting for that trader to look back in the immediate rearview mirror. The shares were worth about 240 at the time. Look at where they're worth right now. They're worth 256. We can look back sort of longingly and say, oh, sure would be nice if I hadn't sold that call in the first place, because now I just own these shares and they'd be worth $256 and I'd be much better off. That's actually a true statement at that moment. But what some traders can lose sight of is that just because we own shares that are currently profitable doesn't mean they will always remain profitable. It doesn't mean that we will take profits at the optimal time. In this case, we were forced to take a profitable trade that may have subsequently been more profitable. But from here, if shares were to collapse, there's nothing to guarantee that trader, unless they know that their time is good, those unrealized profits can turn themselves into losses while we're trying to figure out what to do. In any case, we don't have that worry anymore. That trade is concluded. Let's go back to our monitor tab. Yeah, Josh says, twist my arm to take a profitable trade. Arm has been twisted here. And well, we cried uncle on that one for $1,444 profit. Anyway, so now let's start at the bottom. We're going to work our way up because I think Apple is where today's lesson lies. So I want to leave that for last. Starting with Tesla here. This is just a covered call position. Bought some shares, sold a contract at 345 strike. If we want to see that on a chart, here's what we've been up to with Tesla. We bought our 100 shares at 233.07, sold a 17th of April 280 call. That expired, realized a gain, 249. The stock continued to rise. We sold another 20th of June 365 call right up here. That one we concluded in our last webcast. That was on June 9th. It's been a couple of weeks since I was in conducting this webcast series. But yeah, we closed that one out. You can go check the archive for that if you'd like to see it. Made an 863 profit on that call. Sold another call, the 18th of July 345 call for 995. So that has some time till expiration. And really since June, let's see, that's June 9th here. Price has gone up a little bit since that time. So if we go back to our monitor tab and we look at that Tesla call, we sold it for $995. It's still worth $670. Could the trader decide to get out right now and realize a gain there? A little bit over $3. That's a possibility. I'm going to let this one continue to work. Not doing anything with that. With Gilead Sciences, with this contract, we sold again on June 9th into a longer term put option. We did a leaps contract on this. So let's look at this one. So here was where we were discussing this approach. We sold a long-term put, sold that 18th of June, 2026, $80 put. So it's all the way down here. We are way out of the money, $30 and change out of the money on this one, but still lots of time till expiration. Collected 310. I think it's still trading right around 310. So there's really nothing. It looks like we're at 260. Okay, so maybe a trader could look at this. And by the way, we only sold this a few weeks ago. This thing has a year left on the contract. And yet, even though we're only a fraction of the way into that trade, this is what some traders like about selling long-term put contracts. They can go way out of the money, and even somewhat minor moves in the right direction may allow them to close out those trades relatively early in that trade cycle. It's not like we need to necessarily be waiting around for a whole year, but we're going to wait around for another week. All right. So here are two positions where we are going to be making some changes to things. First of all, we have Abbott Labs, and we just own 100 shares. What happened here? Well, this has some history. Let's revisit the history here. With Abbott Labs, we originally bought some shares for $128.68 on this day. Then we sold some 16th of May 135 calls. Those expired for a 132 profit. And those expired right here on the 16th of May. And then on a subsequent day out here on June 2nd, we sold some 20th of June 135 call, or a 20th of June 135 call. That expired for a 191 profit. So between the two, we're up over $3 on realized gains on the contracts. And the stock's actually been cooperating fairly well as well. See, it dipped down here, got down out of the money as we hit that June 20th expiration. So it expired worthless, and then immediately started cooperating again with our just now 100 shares of stock. I think what we're going to do here, let's maybe, how high can we maybe sell a contract? If we get all the way up there at 140 and sell a new call, let's go have a look and see what's available. Oh, let's see what else is going on with the charts. This is something else we might want to keep in mind. Ooh, look at this. There is an earnings announcement. Some traders don't like to hold covered calls or other strategies, some other strategies over earnings announcements because, you know, with a covered call in particular, there's limited upside. So if there's a strong move to the upside, we might not get the full benefit of that move. If there's a strong move to the downside, a lot of exposure to risk to the downside. And that ties into this strategy that I want to discuss today. To some traders, they call it the stock is king or rule. That is because with any covered call position, it consists of two related positions: stock ownership, and then the call that we've sold against that stock position. Now, between those two, which one carries really I can't say all of the risk, because there's some risk with the one. Yeah, the stock ownership carries a massive amount of risk. That stock, if it falls all the way to zero, the premium that we collected on that covered call can be small consolation. It might be $1, it might be $2, it might be 10. We've actually gotten 10 in some cases. But if a stock collapses, it can be small consolation. So if this earnings goes poorly, we can see a strong move to the downside with only a small consolation prize in the form of a covered call for income that we've sold. But that's just an illustration of why some traders consider the stock position, to be the king in this particular scenario. So this stock earnings announcement could influence price dramatically in one direction or the other. And for some, they may just prefer not to have a covered call position, limiting the upside while holding through that. Now, what about just owning stock? Well, the stock made to those same traders seem to be a comparatively reasonable position, because if the earnings goes well, there's no cap on the upside there. If the earnings goes poorly, well, they do have the exposure on a per share basis to the risk that might be realized if the stock collapses. So it's sort of, well, I get the maximum benefit in that scenario. Of that scenario, I also have the maximum loss potential of that scenario. So, well, okay, so do we want to sell a covered call? If we do, maybe what the trader might do, if they don't want to hold that call through earnings, is sell something that expires before earnings. Let's see. So the earnings announcement was on the 17th, wasn't it? That puts it one day before the July expiration. So we might have to turn to the weeklies to see if something can be sold before that earnings. And we're trading at 135. If we wanted to sell, the trader could look up there at 140. There's a pretty wide spread between the bid and the ask price, amounting to more than half of the ask price. That to a lot of traders, they might consider that to be pretty wide. So there might be some liquidity issues. If we move down to where there seems to be narrower spreads, we're looking to sell a premium that's closer to the current price of stock and putting a nearer term cap on the upside potential of the trade. And even then, even though we're looking at higher premiums here, is it enough to make it worthwhile? I think what we're going to do today, let's hit the pause button on getting into a new call position on Abbott and just hold on to the stock position. So that takes us to Apple. Apple is the one where I think Isaiah says, can we sell a call and buy a protective put? Isaiah, so that's a different strategy. that goes outside the scope of this discussion series. So my apologies. It's a good question, but that would be basically collaring the trade, and I'm not going to do that. If you haven't heard of that phrase, if you want to do this, you can go to our YouTube channel. By the way, if you haven't subscribed to our YouTube channel yet, do that right now. You can go down the lower right-hand corner, click on the subscribe button. It only takes a second. It doesn't cost anything. But our channel is where we house all of our previous webcasts, not all of them, but the vast majority of them. Some aren't archived, but the vast majority are. And we organize those into playlists here, but they're also searchable. So Isaiah just asked about something known as a collar trade. So I can just type in a collar, and what do you know? There's the collar strategy defined. Ben will walk you through that. But great resource there to be a subscriber to our YouTube channel and to use these search and playlist functions. You can also join the live streams right here. Anyway, also, by the way, this is where you can go find, like, if you want to see the logic of the timing and the risk reward scenarios of these trades as we placed them. All of them are in my playlist for this YouTube series. So you can go to playlists. You can scroll right down toward the bottom. I believe it's about 4 up from the bottom. Let's see if we can find that. Yep, it is 4 up from the bottom. Trading covered calls and short puts right there. You can go to the view the full playlist. And there was Ben covering for me last week. So my thanks go out to Ben for doing that. But let's go learn our lesson from Apple. Look what's going on with Apple right now. Not making money. It's actually not quite as bad as it looks. Frank says, can you explain on a risk-reward basis how cash-secured puts compared to covered calls? I'll summarize it for you very quickly, Frank. There's almost no difference depending on if we're trading same stock, same strike, same expiration. So guess what? You may want to check out a webcast that I did where I addressed just that, Frank. It's a good question. Let me see if I can quickly find that. Puts and covered calls. I might have to go track that down. I don't remember how long ago I did that. Yeah, I'll have to go look around. Or you can look through the archives. But yeah, I've done a webcast dedicated to just that in the past. But basically, they are closely related sister. That's what I would call them, sister or cousin, or I know they're more like siblings strategies. Anyway, but our Apple trade here, we're down $3,300 on it as it's currently constructed if we're looking just at the current shares and the current contract. But that's not the entire story with Apple. Here is the whole story with Apple. All right, we'll let those graphics load that I drew on there. Frank, you'll look that up. Hey, my pleasure. All right. Let's go here. There we are. All right. So here's the history of Apple. We originally started this off by selling a put, the 235 put for the 21st of March. That was assigned. So we kept the $3 premium that was originally collected, but now we own shares at 235. That's up. That's right there, 235, right there. Then we sold some calls against that 235 position. And those we closed out for an 80-cent profit. Oh, good. So $3 here, 80 cents there. We subsequently sold a 16th of May call, closed that out for a 149 profit, sold a 20th of June call, and closed that out for a 225 profit. So if we tally all that up, let's see. We're at 380, 480, about 530, 529, 729, 754, something like that. $754 in realized profits on previous calls that we've sold. That's not reflected in this number. So you could essentially subtract about $750 from that. And that's really where we sit. So we're still down, but overall down about $2,500. Not as bad as it initially seems, but still not great. Now, most recently, we've sold an 18th of July 220 call for 177. We did that on June 9th when we last convened. And that's lowered our break-even point overall to 225.69. If we bought the shares at 235, and we've collected closed some premiums, collected more. We've now collected about $10 net in premiums, lowering that break-even point. Well, look at where the stock is right now. We're still well below break-even. And if we were assigned on this 18th of July call, we would be, even then, not breaking even. We'd be better than we are right now, but not breaking even. All right. So what's the lesson here? We have rolled several times, continued selling calls against an existing stock position, but who is king in this scenario? Stock is king. And in this case, they are a miscreant of a king. They are a misbehaving king. The stock has been going down and down and down, and selling calls has reduced the damage, but has not prevented the damage. And I think that some people, some traders, it's easy to get our focus entirely on the calls that we are selling. Love collecting that income. Guess what? That comes with risk. If we ignore that risk, we can wander into the darker corners of performance that we didn't intend to. So let's do some revisionist history here. Look back over this trade and see if there's some other way a trader might have approached this one. If we bought shares back here, not bought, we were actually assigned the shares. It was a forced purchase, but nonetheless, were there any signs along the way that the trader might have noted? For example, let's throw in, and this is, of course, this is the benefit of revisionist history. We can see things with nice, clear 2020 eyes, right? Let's look back here, and you notice when we were assigned those shares, that 230 level was kind of interesting. That had previously been a resistance level, and then it had broken up, and possibly it was acting as support around the time the contracts were assigned. Then we started to break down. To some technicians, they might have seen that, boy, there's something might be important that's happening here. The stock is starting to misbehave. Now, if they're focused entirely on collecting premiums, they might be willing to ignore that behavior. But in this case, that has come to the detriment of that trader. Another sign might have been, hey, we also broke through. We had an upward trend here. We broke through that. In any case, we've popped down and through, selling some premium, trying to dig ourselves out of a hole. Well, stocks have quite the ability to dig deeper holes. So, that's history. But what I wanted to learn from this is, were there possible technical signs along the way that some traders might have taken note of and decided, let's just admit that we aren't making money on this one, close it up, and stem the bleeding that way? That's a possibility. What could help things out from here, though? Now that the markets, the stock's price, the king in this situation has dug us into this hole, who has the power? Who wields the scepter of power here to get us out of this hole? I get this question all the time. What can I do with this trade that's gone against me? How do I turn this thing around? Well, we can do things like sell a call, collect a little premium, see if that helps out. But really, it was the stock price that put us in this hole. And it is the stock price that has the best power to get us right back out of this hole. We own 100 shares. And if those shares rally in price, well, we stand to benefit from it. To a point. Right now, we've sold that 220 call. We've collected 177. As a matter of fact, let's go look at that. We have this call. We sold it for 177. It's only worth 30 cents right now. Frank says, is there a way of using the scan tool to find stocks that are most suitable for writing covered calls? That's a great question, Frank. But most suitable is a big, squishy term. Because for some traders, suitable, and this is a good question. Frank, you've asked me a question that's sort of a nice setup for planning our new trade. So what I'm going to do with Apple, what some traders might decide to do is, hey, we collected $1.77. We could exit right now, maybe around 30 cents. That would be about 80%. We'd be able to retain about 80% of the original premium. What I'm going to do with this one, I thought maybe we'd be taking, I don't know, more active action here. In this case, I'm gonna take a more passive approach. Our contract is still way out of the money. We've sold the 220 call. We're still down around 200. It's $20 out of the money. Even a sharp rally, it's very likely that if we just leave this alone, there's another $30 that could be still realized. So we're going to sit on an unrealized gain and hope it improves. Anyway, so we're going to leave Apple there. But to go back to Frank's excellent question, if the stock is king, and that is the contention made by some traders, I don't know, maybe many traders who do covered calls, they don't want to lose sight of the fact that if really the stock that's very likely to determine the ultimate success or failure of the trade, and if stock ownership is a requirement of a covered call position, as it is, maybe the trader wants to make sure that they're picking the right king. Maybe they want to make sure that they're buying the stock that's appropriate for their portfolio, at least for the time that they expect to own it. So how might they define that? Go to Frank's question. There are so many ways to define that, Frank, and everybody. What's appropriate for one trader might be totally inappropriate for another. One trader may, let's say they have an over-concentration in the technology stocks, and maybe they want to blend in a little bit more of communications or healthcare. It could be sector motivated. That could be the reason or a contributing factor in choosing a specific stock. They might also there might be traders who have a preference for growth metrics from a company. Maybe they want to see strong profit margins. Maybe they want to see strong projections for growth in revenue. Others, though, may value. They might be looking for stocks that are currently undervalued in their assessment. Maybe they use something like a PE ratio. So there's lots of ways that we can slice this up. All of those fall into the category of what we would call fundamental analysis. And yes, we can do a scan for fundamentals. We can also do a scan for technicals. And guess what? And the technicals meaning chart behaviors. Guess what I talked about in my recent Getting Started with Thinkorswim? You may want to go look at last week's Getting Started with Thinkorswim, where we talked about searching for stocks based on fundamental factors or technical factors. But yeah, in the selection of the stock, if the stock is king, the first thing that we might want to focus on is when buying, we pick the quote right stock for the investor. Then also when selling, the trader may keep their eye on the stock and not so much on that tantalizing premium that they collected. Now the stock is very likely the driver. Conad says, hi Cam, can you tell more next lesson about the ADX indicator? I can. Yep. Also, make sure that you do this. Quick search for ADX. Hey, what do you know? Using average directional index, ADX, to plan bull or bear trades. There you go. You may want to check that webcast out. Anywho, so let's pick out a stock. And the stock that I'm going to be choosing today, I'm not going to do a scan for it because it didn't require anything quite so sophisticated as that. Basically, some of the more common, some might call them the more essential elements of choosing a stock could be price per share. Stock ownership can be pricey. That can be a consideration. We also might want to keep an eye on liquidity. For some traders, if they see an illiquid stock, they recognize that illiquid stocks have even worse liquidity in their options most of the time. It can make getting into and out of those options more difficult. So I'm going to go with, for today's example, PM, Philip Morris. And here is another consideration when selecting that stock, when focusing on trading this concept of stock is king. For some traders, they just like to see a stock that is bullish. If they're going to be implementing a strategy like a covered call, which is a bullish strategy, know that it can be tempting to say, well, isn't selling a call is that bearish? Selling a naked call is bearish. Trading a covered call for income is actually a bullish strategy because of that stock ownership. So let's put ourselves in the shoes of a technical trader Maybe they've looked at a company like Philip Morris because it's up there in price, but it's not up in the high triple digits, not up in the 4 digits or more, like some stocks are. Buying 100 shares, therefore, may fit into more portfolios. It's also one of the most liquid companies in the world. Stock has heavy volume trading. The options on this stock tend to have narrower spreads between the bid and the ask as a result. And what might the trader look for on a chart? Well, a couple of qualifying events in focusing on this stock is king strategy. Number one, the trader might want to look to confirm that the trend suits what their preference is. And they might do that just doing a manual analysis, looking at cyclical highs and cyclical lows, seeing which way the stock appears to be stair-stepping. For some traders, those higher highs and higher lows can be an indication of an upward trend. And for some, the assumption is that once an upward trend is established, maybe it'll just continue, which could be good for a bullish trade. Now, for others, they might recruit a technical indicator, something like a moving average, which is a mechanical view of trend. So I'm going to go to Edit Studies, and let's add a simple moving average to our chart. Let's add that. And since a covered call, not every covered call is built the same, but it's not uncommon to see these trades, the call portion of the trade, play out in a matter of, let's say, weeks. So the trader may have an emphasis on relatively short-term to intermediate trends. Let's click on our little gear icon, and how about we'll choose, for today's example, a 50-period simple moving average to represent our trend. Let's apply that to our chart. If you're not familiar with simple moving averages, this is, as I mentioned, it can be used as a potential indication of trend. It's not a guarantee that stock is definitely going higher. Salient says, what key fundamentals should we consider when trading covered calls? So I tried to touch on that. Salient, Joe, that's a good question. As I'm doing here, I can provide examples, but this does not apply to everyone. Not every technical trader out there uses like a simple moving average. Not every trader even looks at a chart. In the same vein, as tempting as it is to say, okay, these are the definitive fundamentals that a trader should look for, well, I can't say that, but some potential considerations: what sector is the stock in? Does the trader already have lots of stocks in that sector? Maybe do they need to consider a new sector? Do they have economic convictions that a certain sector is more likely to perform in the near term than others? Anyway, however one selects a sector, that could be a consideration. Another consideration could be growth or value metrics, or a combination of those. And I already touched on a few of those as examples earlier. There can be a lot of things. Even price and volume can be sort of fundamental, not truly fundamental. I think they fall in the gray area between fundamental analysis and technical analysis. Anyway, I hope that's helpful for you. I know you want something more definitive. I know you'd like to see a list. This is what you do. I can't do that. I just don't know my audience on an individual basis well enough. My job, if I were an advisor, which is not my role, I would have to sit down and interview the person that I'm giving these sorts of suggestions to, just to make sure that it fits their risk profile and the size of their portfolio and their stated performance objectives and all of that. Okay, anyway, so our moving average can be a potential indication of trend. In this case, let's just say that our trader sees this. It looks like our 50-period moving average is heading upward. So they might see that the trend in their view is likely to continue higher. But it can also potentially act as support and resistance levels, or it's expected by technical traders to act as support or resistance. You'll notice as price comes down to that average, maybe there's some buying that comes in from traders who see opportunity. Ooh, I can buy the stock down close to average, whereas at other times it's well above average. That's the concept there. So our trader might look for an upward sloping moving average with price getting close to it from above, but still with price above. And then they may pair that with something like a short-term momentum indicator. Lots of them in that general category known as oscillators might serve this role. Let's use our example for today. Let's use a MACD. I'm going to choose the MACD histogram. Let's add that to our chart. There we go. And apply that. If you're not familiar with the MACD histogram, it's a short-term momentum oscillator. And a common interpretation of this is that when it dips low and starts to rise, when we see bright red start to move to dark red, that may mean that the selling momentum is shifting to buying momentum in the short term, and it may signal that we might be at or near short-term lows. So it's kind of interesting with Philip Morris. We have our upward trending stock. It's come down relatively close to our trend line. Prices have gotten closer to average, but momentum seems to be shifting upwards. Not a guarantee that it's certainly going higher, but for someone who's about to buy a stock, and if they subscribe to the concept of stock is king, maybe they want to put themselves in the best position for stock to move higher instead of lower like it has been on our Apple position. So let's buy 100 shares of Philip Morris, and let's sell a call above our entry price. Now, what do we have around the corner here? There's an earnings announcement. How about if we sell, in the spirit of sidestepping that earnings with the call, let's sell for July 18th again. So I'm going to go to the July 18th contracts. Let's go. How high can we go? If we get above about 187.5, 190, you can see these premiums really start to dry up and be fairly small compared to the current price of the stock. That might be okay for some traders. But for today, let's sell maybe that 187.5. To help you visualize that, that's going to be just above these previous highs. If I come here, I'm going to draw that in as closely as I can at 187.5 and take it out to July 18th. About there. There we go. That means if we buy the shares here and they do go up, contracts might be assigned. If we buy at 181.5 and we have to sell shares at 187.5, well, there's a $6 profit potential on the stock. But at the same time, it appears that for this example, we might be collecting around another $1.25 to $1.40. Now, here's another thing, though. If this trade goes well, looks like we could make around $7.50 on this trade. Well, just like Apple, though, Philip Morris might decide to start coming down. And this is where that trader who subscribes to the concept of stock is king, maybe if the stock starts to misbehave, they're going to just pull the plug on the covered call and sell the stock. So they may make a decision up front. If this starts to go down, how far down am I going to let it go before I draw the line in the sand? And one common approach there is to keep the eye on that moving average. If we go below that moving average, let's say down to 170, so not typically just a penny or two below, but some fairly considerable distance below that moving average, maybe the trader at that point might think, hey, King is starting to get a little rambunctious here. I might need to buy that call back and get out. Josh says, why not just collar the stock again, Josh? I don't talk about collars in this webcast series. It's a good question. It's another consideration. And a collar, just so you know, can limit the risk potential on a trade. It can also essentially eliminate the reward potential of a trade, just to address that quickly. But yeah, it's a good question. I just wouldn't ever address that in any great detail in this series. Anyway, there we go. So that's going to be our plan. We're going to be in this trade, let it go if it wants to, but we're not going to be as patient with this as we are with the Apple trade, because we're putting ourselves in the shoes of that trader who says the stock is king. So let's go place our trade. So we're going to go to our trade tab. Let's go to the 18th of July, go to our intended strike price, and we can come over here and just right click and let's put in a buy order for a covered stock. And that covered stock is just Thinkorswim's word for a covered call. So that puts an order to buy 100 shares. That would be about an $18,000 trade, and sell a call at that 187.5 strike. I'm going to do this though. Let's change this to a market order, which literally means, hey, I'm willing to pay whatever the current stock price is. I'm willing to accept whatever I'm paid, whatever is on offer for the premium that I'm selling, just to get into this trade. There are definitely advantages in doing that, increasing the likelihood of a quick fill. Also definitely risks. We might not like the price that we accept. But let's come down here. I'm going to change this from just a single order, just an entry order. We're going to include an exit order here as well. Let's put in first triggers sequential. That means if our first order fills, there's going to be a second or sequential order that goes into effect. And this is to get us out. Right click, create an opposite order. This is to sell those shares and close out of the long call, of the short call, buy it back. But we don't want to do that right now. We only want to do that in this scenario if the stock starts to misbehave, if we got the wrong king on the throne. So let's go over here and click on the little gear icon. And we're going to sell out of this position, but under this condition. Let's come down to where it says symbol. And if PM, the stock, market value falls to or below, what did we decide? Was it, I might have to remind myself. Hold on a second. 170, that was it. Go back here, click on little gear. PM, market price at or below 170. We're not going to give this the time to misbehave on us as much as Apple has. There you go. Now, the one thing I'm going to do here is change this to a good till canceled order, and we click save. So the entry that we're placing here is if the stock falls down to or below 170, get me out of this covered call position at market price, whatever that happens to be, if we get to that point. So stock trader says buy 100 shares and sell 100 shares. Yeah, if the stock falls. If it rises, that's fine. This trader would be okay with potentially, and we always have to be okay. Always is a strong word, but this is just the way it is with covered calls. If the trader is not okay with assignment, if the trader is not okay with possibly having to sell shares at the strike price, they shouldn't be doing covered calls because that's a contractual obligation. Anyway, but let's click confirm and send. Buying these covered calls, the 187.5, selling the 187.5. We're going to sell out of that if PM falls below 170. Now, due to potentially wide market or liquidity risks at the time of activation of the stop, that order may be manually substituted with a limit order upon activation and worked until filled. With market orders, entry or exit, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. And with stop orders, there's no guarantee that the execution price will be equal to or near the activation price. So if we have a stop that's triggered at 170, it doesn't mean that our stock is going to be sold at exactly 170, for example. A gap down could expose us to more risk. So let's send this order off. There we go. We're in to that covered call. All right, guys, but we've accomplished what I set out to do today. We had this trade in our example portfolio, Apple, that we have actually successfully had 5 covered calls sold against it, and yet for some reason it's losing money. That's because, as some traders subscribe, stock is king. At least it can be in a covered call trade. So if we're trading, assuming that stock is king, that can have implications for which stocks we choose for entry and when we choose to exit the covered call. All right. Okay, everybody. Hope you enjoyed that discussion. We've reviewed current positions, looked at the markets, placed a new trade. This is what we do in this webcast series. I would hope that you join me, if you can, in the live events. If you can't, that's totally fine. But just make sure, if you haven't done this yet, subscribe to our YouTube channel. Trader Talks Schwab Coaching Webcast is the name, but that's where we host our playlist for our previous webcasts. You can join the live streams here, and you can search for topics of interest, like the several that have come up in this discussion. Also, make sure that you're following us on X if you have an account with that platform. So you can find Brent Moores there at Brent Moores CS. You can find me there at Cameron May CS, but it's the very best place to connect with me in between these live streams. Here's the guy you're looking for, and there is my handle at Cameron May CS. Always be precise with those handles. Thanks to everybody who's already clicked the like button. Got about 160 people watching live right now. Looks like about 42 have already clicked that like button. That's always appreciated. It's a pat on the back to your presenter, and it gives a boost to their webcast in the YouTube algorithm. Helps more people find these discussions and learn about things like this thing known as the stock is king rule. All right, everybody, I'm going to set you loose. Go enjoy the rest of our webcast through the rest of the day. I'll see you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.